Bill Nygren joins us now to discuss what to do. The 10-year note yield, Bill, at 4.71. I mean, some big reactions here. Dollar yen is above 155. Does this change your thesis on picking stocks for the year, this surprising backup in yields?
Well, good morning, Sarah. Thank you for having me. No, at Oakmark, we are so long-term focused that most of the day-to-day news is just noise to us. What we look at in the market today that we think is really interesting, it's not just that the S&P is at something like 22 or 23 times earnings. It's how large the spread is between growthier companies and value companies. One way of looking at that, the Russell Growth PE is about twice the Russell value, so something like 30 times versus 15. And that number typically is more like 1.5 times. So at Oakmark, where we're trying to sell fully valued stocks and buy inexpensive stocks, our portfolio has kept moving lower and lower in PE, even as the market has risen over the past year.
So to get a little more granular, if you could, about where those enticing bargains are and why you would want to be loading up in this kind of environment.
Well, I think, again, one of the interesting things in this market is how broad-based the cheap stocks are. They aren't concentrated in just one industry. So, for example, we own Capital One. It's at about 10 times expected earnings. That would fall to 8.5 times if they can complete the Discover transaction. We own ConocoPhillips, one of the best E&P companies in the United States. It's less than 10 times free cash flow if oil stays somewhere around $80 a barrel. And most of that cash flow comes back to shareholders. We own Centene, a large provider of Medicaid insurance. Its quoted PE is about 11 times earnings, comes down to about 9 times earnings if you assume they fix their problems in Medicare Advantage. We own Charter, about 8 times earnings. That comes down to about 6.5 times if you add back the amortization and excess depreciation. We think it's a valuable infrastructure asset. How
Bill,
cheap is too cheap?
Yeah. I mean, are there levels that they get to that where it's just you got to throw in the towel?
No, not at all. If fundamentals don't behave the way we think they should, that troubles us a lot. But a stock getting cheaper is just an opportunity getting better.
Yeah, well, sometimes, Bill, it's because the opportunity is not necessarily as great as had been anticipated. I mean, Charter, for example, down today on our parent company's earnings. You know, it's been a challenging environment. The 8 times that you're citing is a reflection, obviously, of that. Why, on this name and/or any others that have those lower multiples, are you constructive on the underlying business? Given to Sarah's point, some of them keep getting cheaper.
Well, if Charter can even just keep business flat, which I think would be a pretty draconian forecast for them, it's got a free cash flow yield of almost 16%. So the return to shareholders would be very high. One of the nice things about buying companies that are selling at such low PEs, you don't have to believe that other people are going to think these are great businesses. If the PEs can stay static, the return to the investor is quite good. And if they move just a little bit closer to the S&P 500 PE, the returns are very good.